Hello, this is Richard Pearce from Finextra TV, and I'm joined here with Richard Conway, who's the CEO and founder of Elastacloud Limited, Microsoft Gold partner and long-term collaborator. I think we've worked on a few projects over the years, Richard, haven't we?
We have indeed.
And we're on the day after SustainableFinance.Live on asset management and investment banking. Richard, how was it? How was the event for you? I mean, in terms of your contribution, you know, I obviously know what it was, but tell me what you brought to the party.
Oh, well, I mean, first off, I've got to say the event was fantastic. I think that there was a great level of interactivity. You know, obviously it was the first time at this scale, you know, doing a remote event like this with the finance community. So I think, you know, in and of itself, you know, what a great achievement. I think specifically for the event that we were involved in, it was a real eye-opener. You know, we had exactly the right balance between advocates for the financial systems and also from the other side, from the project originators who are looking for finance. And I think, you know, that level of experience really came over. You know, we really got an understanding of the fact that project originators, in this case, you know, energy, battery storage type projects, you know, really have that good understanding of every single piece that they need to supply to the finance community. And, you know, financial services as well, even though they understand sustainability and ESG, it really came across that, you know, that some processes were manual. There were some, you know, inefficiencies in, you know, processing data in some places, but there was a real want to do more of these things, like a real view of, you know, how is it that we coalesce taxonomies which we know are a problem, you know, so that we can get, you know, so that we can get good reporting, we can get, you know, good answers to questions without, you know, having these sort of bespoke formats come to us that we have to interpret. And so I think, you know, for me, this is a key area where data science, AI, you know, this whole revolution that we're going through can make a significant impact. And I think that the audience were pleasantly surprised, because we could have chosen many tools to document this, but we chose a mind map tool because it was the fastest way to build linkages between financial rewards and risks. And by the end of the session, we ended up with a spider's web of something that we have to review just to understand how it works, because it's quite a complicated picture of what somebody has to do to get financing for an environmental project.
Yeah, and I think it was seeing you there, you know, sitting there with that sort of consulting data science mindset, you know, using the mind map and bringing together those two protagonists from the, if you will, together, which was really interesting for the audience to see. I mean, I think when you look at your kind of role as a, you know, as a consultancy firm of data scientists, you know, what do you sort of think yourselves, and what are the big themes of technology in that area that you just touched on that can help us crack this code?
Yeah, absolutely. So I think you know, there are a lot of problems on the life cycle that we have, and I think they're inherent yesterday, in terms of, you know, in terms of the financial community not actually knowing what they don't know. So, you know, they want to be able to validate projects, but they can't get information fast enough, and there's no automated means for them to process this. So I think you know, some of the issues that we're going to come across here is that there's obviously a large historical record, because we were talking specifically about renewables projects. We know that renewables projects are you know, constantly funded, but we need to fund more of them to to make the 2030, 2050 targets that we've got. So I think unless we automate more of this, you know, we're not going to be able to you know, to practically approve more of them and to go through this financial validation process. I think the theme is that from a data acquisition perspective, you know, we we need to have banks record everything in a format which is easily accessible. So the projects that are approved, the projects that fail, where certain projects fail to provide dividends, right? It will help them inevitably use newer technologies like AI and machine learning to go back to project originators saying, well, this is what we've looked at in the history of our projects. We've looked at the failure rates, we've looked at the success rates, we've looked at where the margins aren't as great, after 5 years of operation, and then come back and give them advice. So I think that that turns it round to being, a flat sort of response where it puts all of the onus on the originator to try and find out what's in the mind of the financier, but to a more structured process, so that it's just two parties that are exchanging data on both sides. And I think a lot of that intelligence on how to build these projects can come from the history of successes and failures, right? If the data is recorded accurately at that point in time.
I think I remember talking to Norm Judah, senior CTO at Microsoft, and he was saying everybody's been throwing away their data for years because obviously the cost of storage, but really I bet they wish they'd held on to it, because tons of relatively dirty data can now be trawled, and you can sort of infer the signals that come from failed projects, successful projects which you labeled in a different way. So I think everybody feels as though they have to reduce everything down to a few key KPIs, which can then be benchmarked across the whole industry, across whole classes. Do you think it's valid that we can say, no, actually diversity and history and timelines and volumes is actually our friend, because we can subsequently reduce it, so that we can then do our reporting and our benchmarking based on various standards?
Yeah, absolutely. And I think more to the point, we've entered into an era where storage is now so cheap. It's to get gigabytes on OneDrive or Dropbox or SharePoint cost, a few pennies or a few cents. And I think that one of the things that we're beginning to see is more derived data acquisition. So you'll find out that data aggregators will scrape the web. They'll also build histories from captured data in forms that go back like 20, 30 years. And, whereas 5-10 years ago, we had problems with lexical analysis of things, now we have natural language processing capabilities with models that can infer all of the meaning in any of the words that we need to, so what are we trying to say on a written form, and we just understand it, even if, to the extent where we can get the machine to understand it better than people can.
Yeah, exactly. So tell me, you guys, obviously we had one of your colleagues dialing in from Miami. Where are you operating these days? And do you see, this kind of some of these patterns that we discussed yesterday emerging in your different geographies?
Yeah, so I think it is very interesting. We're operating in the UK, we're operating in the US. We have a small presence in the US, and we're operating in Spain. I think the UK market is incredibly mature, and of course, everything centres around London in the UK. To a lesser extent, some of the other big cities like Birmingham and Manchester, but most if not all of the financial service sector is here. The US has got a lot more diversity. It will operate, within Florida for some tax reasons, in New York, some on the West Coast, and so I think that it's with the US. The US is the Americas are a continent, and North America, is huge, and trying to put the UK and the US side by side is very difficult. But I think we see similar emerging phenomenon in the US. But I would say from our market presence, in terms of the European markets which we're involved in, the UK is ahead.
Yeah, and I think certainly if I look around, Holland, Scandinavia, when it comes to sustainable finance, the financial industries in those organised countries are very strong. So just to wrap up for now, this is a short conversation. I'm sure we'll have a longer one. Tell me, from the event itself, what's the key kind of couple of takeaways for you? What leaves you with hope that we've seen the challenges, but that shows us the path to the solutions.
Yeah, I mean, I would say I would say that I've been involved within the renewable space in solar, and I've understood all of the hardships that solar farm manufacturers and asset owners have, all of the margins that they have as well. And I think that one of the things that the finance community likes to do is understand volatility. One of the points that was made yesterday was that by there are ways to couple things together and classify them. So you can eliminate volatility by understanding the place of battery storage in renewables. I think there's a tendency to look at different project types separately. Whereas we're entering into a new phase where technology is caught up with our imagination of how to solve some of these problems. So I think the financial community has to have better models to put these things together, right? So that we can come out with overall predictive models to say we will be successful, if we build a new solar farm, if we use if we use this type of battery technology, whether it's what Keith was talking about, compressed air, or another type of storage technology, and it will yield this much, and we can trade this on the open market, so that we don't need to curtail our reward with long power purchase agreements, just to ensure that we can get the debt. So I think that in this case, data, AI, it can bring all these things, and it will be pushed back into the financial community to say, what, we've got better forecasts now, we've got a better understanding of how we can assess these markets, and it doesn't quite follow that we should fix our price over such a large term, erode our profitability, because we've taken on all the risk already. So I think that these technologies will see a much better understanding of the risk reward ratio, and I can see these coming in now.
Fantastic. So that's great. I mean, it's that move, isn't it, towards the fourth industrial revolution. The corporates, the industries have now got these tools where they can be much more predictive in their analytics. And so you're saying the financial services industry needs to perhaps change some of its models to be able to therefore take on some of these kind of great investments in a different way, which allows more investment sooner perhaps than was previously the case.
Exactly.
Yeah, fantastic. Richard, as ever, delighted to catch up with you, and thanks so much for your effort yesterday. We'll be getting the videos out to everybody soon, so look forward to talking to you shortly.
And you.
Thanks a lot.
Bye.